Hey traders, welcome to another episode of Charts and Coffee. Hope everyone's doing well. Uh, Look, I've had a little bit of a scratchy throat the last couple of days, so hopefully the audio and video is okay. All right, maybe it's just too many hours in the mic, but I do love it, and I do appreciate you guys showing up, our Charts and Coffee crew, each and every day, Monday through Friday, 9 through 9:20. Great to see everybody. All right, so let's get to it. We got a question right off the bat here from Line Watcher. Hey there, how you doing, my friend? And let's see. Let me click on that question. The 10-year. So the idea that, whether it's the 10-year, whether it's the 30-year, I think the long bond has had a lot of folks' attention. You can see what's happening there in the long bond, the TLT. So let me show you where I look at this stuff. I look at two things. I look at Quandl, which is a site that I use just for a quick reference of the yield curve. And this is important because, especially for those of you that are tracking gold, this movement higher in the 30-year is not going to be conducive to what I'd like to see in GLD. Now, why do I bring that up? Because it's hard to talk about yield curves and not talk about gold. I think, though, to answer your question as succinctly as possible, do I think that the 10-year Treasury bond will ultimately derail the stock market? Ultimately is what? There's a great quote, and I'm certainly not taking anything away from him because this is the Dr. Michael Burry. You guys probably know him from The Big Short, the book, the movie. And he says, I may have been early, but I wasn't wrong. And in all respect to Michael Burry, that's the same thing if you're a trader. So I kind of use that quote here in terms of what the 10-year might be saying, where it may not be wrong, but it may be early. And that's kind of the same thing for us when it comes to trading. So no, I think what ultimately derails the market is the Fed not communicating what their plan is for rates, because this market is firmly drinking from a very spiked punch bowl. And the old college saying is true: avoid the hangover, stay drunk. And I think that's really the best answer. I love where your head's at, Line Watcher, but the truth of the matter is the Fed's got both hands on the wheel here in terms of where they're driving this market. And even though it looked like Fed fund futures and the long bond were trying to suggest that they were losing control of the longer end of the yield curve, I think the way we've seen the resurgence, the previous two sessions tend to show that, nope, the Fed's still going to do what they can, hanging on to that. And even if it does, look, it reminds me of the very first time I actually wiped out on my motorcycle. It doesn't sound as dramatic as it was. It was, the wheels washed out from underneath it. And I'll tell you what, so I was a new rider, maybe riding for less than 12 or 18 months. And I've got my hands on the clip-ons, and the whole way down, I just never let go. I could save this, and that's kind of the Federal Reserve. I think when they do finally, look, have they created the asset bubble? You bet. You bet. So Harry asks, what do I think about Riot and MARA? So these are both Bitcoin names. They've actually, from a percentage basis, outperformed Bitcoin last year. And they're going to move absolutely with Bitcoin, as a lot of names are. There are many names that are moving with Bitcoin. They've either purposely tethered themselves to the Bitcoin narrative. Riot and Mara clearly are plays on that. So as Bitcoin pulls back or stalls, you'll probably see an exaggerated reaction in the likes of Riot and Mara. So when you look at the pullbacks here, if your narrative on Bitcoin is bullish, if you still have a bullish narrative, if you're a hodler, got diamond hands, you're going to like the pullback opportunities in these too. So it's hard to argue with the double green. It's hard to argue with the uptrend that's in Bitcoin. And that's really what you're watching, my friend. And whether you're looking at Bitcoin, US dollar, which is usually where I go, yeah, if you feel bullish on Bitcoin, then you are absolutely going to like the pullback buys on those two. So thanks for the question. And the answer is potential anytime they re-enter the wave, 34 EMA high to low in a double green environment, meaning an uptrend that would be, in the parlance of Dow theory, a mark up. Always get the market environment first, the setup, the indicators, then naturally come from that assessment. So thank you for the question. All right. So, hey there, Trisha. How are you, my friend? FYI, the video always picks up about halfway into my. Oh, does it? All right. Good to know. Maybe I should let the video catch up. I know there's a slight delay in the way it replays, but good to know. I appreciate that. All right. Next up is N. Lewis. MCD is the chart pattern. Well, let's go over to MCD here. So that's MCD. Is the chart pattern the same as CRM? So if it's a time frame other than the daily, let me know. But so the underlying environment is what I start with, and the way that I've automated that process is with, when I refer to something double green or yellow or red, I'm referring to the way in which the 8, 13, 21 and my 34 EMA wave are interacting with each other. So 8, 13, 21 is a more sensitive read on the sentiment and the momentum of the market, while the wave, the 34 EMA high, close, in low, is the way in which I ascertain the trend. So with that being said, no, CRM, and we can get right down to the date, right? When did CRM turn into an uptrend? On the 17th, it turned into an uptrend. If you take a look here, on the 17th, and having done that, in terms of this double green uptrend, it is markedly different in terms of what I'll expect for support when it pulls back. It's markedly different because it's a trend now, and McDonald's is not. McDonald's is still yellow, which means I would focus on oversold buys versus pullback buys. Right? One's a trend, one's still chop. So thank you. Does a 200 period exponential play a role in that? It will only play a role in so much as long as we're above the 200, there's a general bullishness. So while there are both buys, they're buys for different reasons, and they're buys in different setups. One's an oversold buy, McDonald's. One's a trend following buy, Cisco. But being north of the 200, S or EMA inherently is quite bullish. To me, there's a bullish sentiment overall. All right. So next up is William said, I thought you surfed. Oh, surf. And I used to ride motorcycles. Now I just hang out in my office. I surf the markets and I try not to wreck when I'm trading. There you go. I've transitioned those hobbies into the digital, sometimes safer environment. At least no bodily harm, I don't think. All right. So next up, Zen Daily. Sure. All right. ZEN. Okay. So if I'm looking at ZEN, it just went double yellow. Not that that's inherently a problem, but it isn't the same quality uptrend. And we would have known this anyways. So let me point out a couple things here for you to consider visually for how you would gauge. Here we go. Look at that last pullback. So it's kind of behaving like it did before, right? Which is not a strict respect for the wave. But generally speaking, it's hard to say it's not moving higher, right? So it's definitely a bullish market, but when it does pull back, it tends to do so with a little bit more volatility, a little bit more drama, no? So that's what we want to keep in mind. It's this overall trend to the upside that we trust, and it's the pullbacks that we want to buy into with a acknowledgement that the previous, and even if you go back, look, this one that's perfect. That's textbook. This was pretty good too. But the most recent is what I'm going to gauge in terms of personality. And so viable, yes. One thing you can do, and this would be a little bit more geared towards those of you that like an intraday confirmation to a longer term time frame, multiple time frame confirmation, right? This is something a lot of traders do, like to do, prefer to have. I don't make it a big part of my trading any longer, but it's certainly something that influenced my trading for a lot of years, mostly on the Forex markets. But what you could do is look for a compressed market or a reversal pattern on a shorter term time frame. And using something I call the wave reversal or 1, 2, 3, you would be looking for bullish follow through between 150.20 and 151.50. All right. So that if you're looking intraday, that would be on the 15. On the 60, which would require the market to move a little bit higher, you're still 151.20. Yeah, about 151.20 for that break. So you could use a shorter term time frame and maybe some volume levels to confirm that there's enough bullishness to break the ceiling overhead and get the market continuing back to the upside. And it is that continuation that I would look at. All right, what about the NQ? NQ has been your relative, it's your lagger. So you look more at the indices relative to one another. Dow and Russell have been outperforming. S&P has been caught in that tug of war between the NASDAQ and between the Dow. The S&P, as popular as it is, and this is something that a lot of folks don't adopt into their analysis of the SPOOs as they're known. If you're a futures trader, you know what I'm talking about. The S&P, because of its weighting, mostly behaves like and in sympathy with NASDAQ. Because if you take a look at the first 4 to 5 names in the NASDAQ, forget the weighting for a moment, and then you take a look at the first 4 to 5 names in the S&P, they're exactly the same. So where tech goes, really the market goes. And that's because tech is also very heavily weighted within the Dow as well. But the ES also has weighting in financials and in healthcare, and that kind of leads it a little bit over to the Dow side of influence. So the S&P is always in this tug of war between the NASDAQ and the Dow. So if you're bullish, the NAS, I would tell you focus on the S&P or one of the individual sectors. I would not go straight into NAS. We can see once again it's having a hard time with the footing. And I'll tell you what, I haven't seen any good explanations as to why there seems to be this disdain for all things NAS, right now. SMH, the semiconductor sector, continues to outperform. XLC, your communication sector, has been holding. XLY, your consumer discretionary, has been a little ugly if you're getting down to the sector level. So I think being more granular and looking for relative outperforming sectors and individual stocks will serve you better right now, Ramesh. And I would also say focusing on the S&P rather than the NASDAQ, because it will move with tech. But if the Dow continues to outperform as it has, the S&P should be more resilient. All right. So thank you for the question. All right. Didier, how are you? Taking a look at QRVO. All right. So QRVO, what do we have here? Let's start with what I talk about so much, which is down in here. Of all the things that I could focus on in a market that I think still has a path of least resistance going higher, it's really difficult for me to want to be a buyer of of QRVO unless it's oversold. Sorry, gang. Like I said, I kind of, I march on with my day, and then every now and then I kind of realize, I might not be feeling so good. And it's been a while, but yeah, I don't know that I'm feeling so good. Sorry, gang. So in terms of overall directional bias, I mean, clearly, it's bullish, right? It's a bullish directional bias, which has begun to congest. Anytime we see look, I hate drawing trend lines, but I'd be silly if I didn't at least connect these dots. Let me show you something. If you guys want a rare occurrence right now, you're getting it. I don't typically ever draw trend lines. In fact, I have a saying, friends don't let friends draw trend lines. What I'd rather you do is use a volume weighted average price. However, this market is, as you can see here, sort of between that Darvis level and that downtrend line there, it is starting to compress. It's starting to congest. Congestion patterns are interesting. Eventually, they're going to squirt out of that squeeze, right? In other words, as the wider volatility just continues to get contained by the triangle, symmetrical, asymmetrical, the pennant, whatever it is, it just continues to get pressure from these two lines converging on one another, creating less and less space for price to move. Eventually, it's just going to squirt out of that zone, that area. I will assume, as continuation patterns like triangles typically are, is looking at more movement to the upside, right? I'm going to look for that continuation. So there's two ways you can do this. You can drop a pair of dueling volume weighted average prices, which I love to do. I would drop one from this swing high here and this swing low, that swing high, that swing low. And I would wait for the market to have a volume break, or this is what I would recommend. This is what I teach. And I have no skin in the game in QRBO. See that zone right there? I like it. I like that zone a lot. That's a point of control, plenty of volume, good proximity to these wicks, these lows. That's going to be the buy zone. So I'm going to pick a side. A lot of traders like to see sort of a tripwire entry whereby they are seeing a resistance level broken, preferably with volume confirmation. And that type of breakout buy is very popular. I'd say most of the marketplace likes to rely on breakout buys for their entries. Now, if you're a student of market trend analysis, a la Dow theory, even those of you that like Wyckoff, however you pronounce that. I've always said Wyckoff, like a candle wick. I think it might be Wyckoff. But anyways, whether you're studying Charles Dow or Richard Wyckoff, I think Richard was a teenager when Charles was sort of loosely, he didn't call it Dow theory, but when he's loosely formulating all his concepts and approaches. So you'll see a lot of overlap there. Tomato, tomato. The point is, if you start all your analysis with the underlying market trend, which has been the bedrock of everything I've done in my career. I mean, think about it. If you're a trader in the 1980s, late 80s, which I was, where could we go for information? The library and Walden books. Now I'm really dating myself, right? And in the library, I had access to old issues of Task, Technical Analysis of Stocks and Commodities, and old books. And so a lot of what I do sort of is flavored by the fact that I taught myself how to trade in a pre-internet environment, in a pre-electronic trading environment. And so a lot of what I read, all that I had access to were things like the writings of Charles Dow, Richard Schabacher. I mean, those are, to me, you look at every bit of technical analysis and market trend analysis that's come since up till now, you will find, whether they give credit or not, and they should, they are rooted in something that Charles Dow wrote about in the late 1800s, early 1900s, and what Richard Schabacher wrote about in the early 1900s. And so, you're going to see that flavor everything I do. So you look at volume, you respect the underlying trend, and we'll look for a continuation, and you can basically front run the buyers without the necessity for a brand new breakout if you look at the lower end of the range. So I hope that little deep dive makes sense. And that's probably what I just explained there in those few minutes. If you're saying, Rag, I'm not sure how you trade, and I'm not sure if it's a match to the way I like to look at the market, that right there is probably a really good synopsis of who I am and how I like to do things. And, that gives you a good idea of, how I trade. You know, when I decide to put my money at risk, what is it that I need to see? What are the boxes I need to check? All right, PAYX, very similar conversation, my friend, in terms of what I would look for there in terms of same idea, choppy market, oversold buy, stochastic, ready, aim, fire, etc. Yeah, Steve, yeah, you guys now have evidence of my putting a trend line on a chart. You guys will have to keep that quiet. Friends don't let friends draw trend lines. And you're going to tell Mr. David Starr? David is one of the traders. Well, you guys probably know David. He's the creator of the Voodoo lines. He is the creator of Ready, Aim, Fire. And he's popular in all our rooms here at Simpler. Yeah, don't you go tell David, Steve. All right, exactly. Seth, I'm dating myself, but I think Gen X is the greatest generation ever. And we grew up in Walden Books and the arcade. Absolutely. Absolutely. And with that being said, gang, it's time for me to go off to my day job in the futures room. Time to do some day trading. I will see you guys here tomorrow, hopefully with a less scratchy throat. Tomorrow, 9 a.m., same time, same station. Be good to each other, gang. I'll see you tomorrow.